As a member of the board of Cadbury Schweppes, we would approve the bid for more than $4 billion to acquire Adams. Reason being, the value for Adams alone is estimated about $3 to $3.5 billion, which is below $4 billion, but the approximated worth of the company with the synergies that would be created is closer to $5.6 billion. This means that Cadbury would only need to make up about $1 billion in synergistic value. And if we take a look at their matrix of synergy, even if they only focused on the right side on the easily implemented synergies, that would be equal to about $1.5 billion and would already make up the difference that they needed. So because of that, we think that it's a good value to make a bid that high.
Okay, based on our assessment, we do feel it's a good strategic fit based on the foresight, insight, and cross-sight. So the foresight looking at Adams being the leader in gum sector and halls, innovation in new products and tastes, and gain market share in new areas, especially in the US. The insight unique assets includes Adams has maintained a leadership in gum and sugar confectionery in over 33 countries. They have 4 core customers, Walmart, Costco, and 7-Eleven, including ExxonMobil. And then the cross-site includes their R&D, production services, distribution, and lastly, a strong cultural fit between the both companies.
In question 3, we're asked to kind of evaluate the synergy plans and whether it makes us more or less likely to support the bid. Although Cadbury Schweppes has identified a number of potentially valuable synergies, many of the higher value synergies do not appear to be unique to Cadbury Schweppes. As a result, other bidders may also look to these synergies as justification for higher bids and drive up the price. That said, as mentioned earlier, to break even, Cadbury Schweppes only needs to generate about $1 billion from synergies to come out ahead. And if they focus on the easy and high impact strategies first, they can generate a good portion of that. And so I think this would multiply make us more likely to support the bid. Regarding those synergies that we tend to believe the synergies that result in cost savings from economies of scale. For example, number 52, optimizing manufacturing costs by elimination of duplication of assets. And we tend to be more skeptical of the relative ease that Cadbury Schweppes thinks that it can launch 2 successful pocket confectionery brands in a competitive market.
Okay, as to which price we should do and what should we do, this gets kind of tough because we are buying at a premium, but we have other players in the market, and that's what kind of needs to happen if we want to play in this market. There is also something else to be concerned about. This is a wholly debt-financed purchase, which means that if this fails, Cadbury is probably going to fail with it. So in a sense, we are betting the farm on this purchase. This is everything or nothing kind of deal here. In a realistic case, we would probably go in with a bidding process. We bid something around $3.94 billion, see if they bid. If not, we'd move up. But it seems to be in this case that it's more of a silent auction, if you will. You put in your bid and they take the best one. We do have a lead because they want to be part of Cadbury, but that still doesn't mean it will work out well. The final price is probably going to end up somewhere in the $4.1 to $4.3 million range, in which case the synergies that we've listed will probably work out in our favor. There are some strong synergies there. There are also some non-unique synergies that will probably work out and make us a fortune. So we believe this is a good deal. It's not a jump up and down, yay, this is a grand slam. It's gonna be a little scary, but overall, it's the best strategy is to buy the company. Thank you.